Hey folks, welcome back to the channel. This is my daily update here. Want to talk about some stocks for the recovery today. So briefly, and I want to get a lot of questions from you guys in terms of what stocks you are looking at for the recovery. I've got a few ideas out there. A lot of them are stocks that have been on our radar for a while that are now in buying territory. I do want to talk about whether or not I think market volatility is over. I don't. I can't predict where the market is going. I especially can't predict where individual stocks are going to go. No one can actually do that. In fact, the data behind the whether or not humans actually have the ability to predict where stocks are going is shockingly bad. We are shockingly bad at it. So take all of what we say today with a grain of salt. This is not a recommendation to buy, sell, or hold any security for the long term. But I do want to talk about individual stocks today, which are some of the ones that are going to be best for a recovery. And I'd love to hear from you guys as far as which ones you're looking at. So very quickly, we're going to go over kind of what the markets did today. And before we start the discussion in individual stocks, and as of right now, and it's the market is just coming to a close. Looks like the Russell 1000 or Russell 2000 rather is down by 1 point, about 0.6%. The Dow Jones is down by 233, about 0.7%. The much broader S&P 500 down about 1.1% or 43 points. And the NASDAQ 100 off by 1.7%, down 215 points. This is, of course, after the NASDAQ has had a pretty good 2-week run. It's recovered about 11%, at least as of yesterday, it recovered about 11%. So, happy to talk about any stocks out there that are on your radar. Number one stock that I want to talk about today that is on my list as far as stocks I'm personally going to look to acquire is, of course, Amazon. So Amazon made a lot of news earlier this year by going through a 20-to-1 split. But optimism kind of faded even as that was announced. And basically it's around 2018 levels right now. It's just above where it was in 2018. I do think that this stock has a long way to run. And since the 20-to-1 split, getting into it is a lot more palatable than spending, $3,000 per share. So it dropped about 30% or so since the beginning of the year. This kind of matches what happened in 2018 during the last market correction. It lost a quarter of its value again in 2011, 2014, and 2016. And of course, there's always 2008. But when you look at the overall trend for this stock over a long enough period of time, the trend is pretty much positive. So I definitely want to take a look at Amazon here going forward. In terms of their earnings, they are still doing just fine. But let's remember that as the producer prices start to increase, there is a little bit of a time lag in between when those prices are passed on to the consumer. And remember also, there's a lot of third-party sellers on Amazon as well. So I think you're going to see prices increase in terms of items on the store. The shares trade at about 2.3 times sales right now. That's lower than the overall S&P 500 at roughly about 2.4. So it's not cheap in the traditional sense, but it's kind of that price to earnings level is at a 6-year low for Amazon. And I think that as an entry point for a new investor on Amazon, it does make a lot of sense. All right. So that's one of the first ones that I wanted to cover today. So let me know what you think we should be looking at in terms of stocks here. One of the things that I'm probably not going to talk about on my list today is a lot of real small tech stocks. So it's not just real small tech stocks. A lot of tech stocks over the past couple of years have really been fueled by venture capital dollars. And that is not necessarily coming to an end, but pricing dynamics are changing for the services of these companies. And one of those or two of those companies I'm thinking about are really Lyft and Uber. So the prices for rides have been artificially cheap now since inception. And that's largely been because venture capital dollars have been subsidizing the cheap price of rides in order to get it out to a wider and wider audience. So I've been using Uber since 2014. I don't remember exactly when I started using Lyft, but I tend to use them a little bit more. And but that's kind of coming to an end. And what we're seeing right now with prices is more of a reflection of what the actual service is going to cost. That's going to occur for a lot of smaller tech companies, and it's going to put a lot of pressure to raise prices on those for services. So fintechs are one of the things that I'm definitely keeping an eye on. I've been slowly acquiring more and more upstart shares. I don't believe that the danger is over for upstart. I believe that they're going to have a tough run here in the future, largely because it's going to take a long time, 2 or 3 quarters at least, before the increased credit spreads are reflected on their balance sheet. Also, remember, they don't have much of a balance sheet at this point. They typically don't hold the debt on their actual books. They turn around and sell it, and they usually get origination fees for creating these portfolios of loans for other companies. Some of that appetite has dried up, so now they're selling those loans on the open market. And it looks like last quarter they took a loss on at least one of the the books of loans that they ended up getting rid of. So next on my list here, in order for recovery stocks, is PayPal. So talked a little bit about fintech stocks, and I think PayPal represents a pretty good opportunity here. So everything related to fintech or distributed finance or or decentralized finance has really just gotten smacked down in 2022. Now, a lot of the dApps or distributed finance apps that are out there that are based on blockchain, some of that is understandable. A lot of those technologies in the future aren't going to work. And I'm not saying all of them won't, but I'm saying a lot of them won't. And trying to figure out which ones are going to is going to be difficult at best. But some of the companies that have gotten unjustly punished here are really not so much Square, because they've got this hard pivot towards blockchain, but really PayPal. So anything related to fintech or distributed finance has just gotten crushed. And I think that the sector is still ripe for transformation. And a large part of what dragged them down is speculation in cryptocurrencies. And I was reading a Kiplinger's article earlier that basically said that El Salvador adopting Bitcoin as legal tender was kind of the nail in the coffin in terms of the bull run. Less than 2 months later, the price peaked and it's been in free fall ever since. But yeah, so cryptocurrency may be not ready for prime time, but the rest of the world of finance is probably ripe for disruption. And PayPal holdings right now is down more than 75% from recent highs. And it trades right now at about 3.7 times sales. That is the cheapest that PayPal has been in its entire history as a public company. And this still is a growth company. And if you're not interested in buying the company, a growth company that has a solid history of growth and a solid future of growth ahead of it, when it's down by 75%, then I have to ask you kind of what type of investment are you doing here? So I think PayPal also represents a pretty large value in this market. So so one of the other ones is something that's been brought up on my channel a couple of times. And honestly, I wouldn't have known about this company if someone hadn't brought it up on my channel, because I've never seen one of these locations. But Dutch Brothers Coffee. So one of the things that we've tracked is, how a lot of these self-help finance gurus, they keep saying that everyone's $5 Starbucks coffee is a reason that they're poor. I certainly don't believe that, but there is something to be said about these small luxury items like an expensive coffee. That's one of the things that seems to be not necessarily recession proof, but it holds up really well in a recession if we are in fact in a recession. And as far as what politicians are signaling right now, we may not officially be in a recession. So when we look at Dutch Brothers Coffee, that trades under the symbol BROS, it's trading at right about $33 a share. Last time I looked at it, founded in 1992. It's been around for a while. Got a market value, a total market cap of about $1.8 billion. So they have 538 locations spread over 12 states, and it plans to open another 130 stores this year. It's a tough environment for companies in the food and drinks business, largely because labor is expensive and food prices are going up. But the sort of shift in consumer spending to experiences and convenience doesn't seem to be impacted by inflation so far. And these little luxuries, such as on premium coffees, tend to be recession resistant, not recession proof. And it helps you escape a little bit, as this article says, from life's frustrations. So that's one of the things that I'm definitely looking at right now. I guess the biggest company that I'm looking at, hold a second here. Google is around 20 PE with huge margins. Regardless, its earnings result should be okay. So yes and no. Google's earnings results are going to be impacted by the change in privacy policies from the iPhone. And this is something that I'm involved with pretty regularly because I do a lot of online advertising for a bunch of different businesses that I'm in. The targeting of ads has gotten significantly worse because of the new privacy policy with Apple. It's an opt out policy where you have to opt into data sharing. As people renew their devices or get new devices or they upgrade their operating system, we're seeing a lot of that sort of go away. So we can talk a little bit more about Google here, and I definitely want to talk about that. But they're really, as far as internet content and information, they're the largest server of that on the entire planet right now. They also recently announced a 20-for-1 split. This is going to take the shares down to the low hundreds based on the current price of right around $2,100. So the stock split has received a lot of attention, but it's going to make shares a little bit easier for retail investors to own. I'm wondering though, is it's a prelude to something else here going on? Meaning, are they going to be included on one of the major indices? I'm not really sure about that. So, but they're down by a quarter from their 2021 highs, and recently we're down just shy of a third, and it erased about a year's worth of gains. But even after that tumble, those shares are not necessarily cheap in the traditional sense. They're a little bit cheaper now based on the number you said. They're 3.8 times sales. Let me see if that's actually accurate here. So my question, this is a good one here. So 20 times price to earnings, but about 3.8 times or about 5 times sales here. Hold on a second. I'm trying to get rid of some of the screens here that I'm looking at. We're going to talk about that. So, but look, like I said, still not necessarily cheap, but cheaper than it's ever been. And despite the company's giant size, it enjoys quarterly revenue growth that regularly tops 20%. And it's a fat return on equity of over 30%. So I do think that we're going to see a significant impact on earnings going forward as companies adjust to the new reality in terms of the inability to target as well. Now, in the past, Google has used data, of course, from their phones as well as from iPhones to target ads. And they do this through a variety of different ways. It's not just advertising. Google controls advertising through a lot of like third-party things too. So Radshaw says, my question is buying QQQ versus Apple, Amazon, Nvidia, and Microsoft. Not a terrible idea at all. Look at the statistics behind stock picking. Most people don't outperform the index, but the only way to outperform the index is to pick stocks, right? So roughly 70% of my portfolio is in a well-diversified ETF, selection of ETFs, and about 30% of it is individual stocks. I've hit all my home runs, of course, in individual stocks. I don't talk about the times I lost my rear on those stocks because that has definitely happened time and time again over time. But overall, the home runs that I've hit have more than made what is going to be my retirement in the future. And that is socked away in a relatively safe and diversified fund. So that is not a terrible strategy at all. I use VTI for a large portion of my portfolio, which is the Vanguard's total stock index fund, which is not just the S&P 500, but it's everything that represents the market worldwide. And that has provided me very good results with a little bit less in the way of volatility than QQQ. So Anuj Gupta says, what do you think about dollar value for export? So our exports are going to be hurt by a strong dollar. That's that's just a fact. Is that the strong dollar hurts exports? It makes our products more expensive overseas. It makes foreign products cheaper. And even though we're going through a lot of inflation in our country here in the United States and also in Canada, it doesn't seem to be as bad as some other places that consume our products, particularly South America. Inflation is starting to get out of control there. And remember, inflation is a feeding cycle, like a positive feedback loop cycle to a degree. And breaking that is going to take some drastic action on the part of the Fed. So, Fed raising interest rates is not over. I think that the consensus estimate at the beginning of the year for the federal funds rate by the end of 2022 was right at 3%. I'm saying it's probably going to be closer to 4% by the end of the year as the Fed tries to demonstrate that it's really serious about ending or slowing down inflation. So will it result in more deficit? What do you mean? Do you mean trade deficit or do you mean like government deficit? Because trade deficit, for sure, it will result in more trade deficit. In a free trade world, where we're really just counting manufacturing goods and not necessarily services, our trade deficit looks pretty bad. When you add services into the mix, the trade deficit looks a lot better. But no, a strong dollar is going to result in more deficit. So it's very beneficial for you if you're taking a vacation overseas to Europe or to South America or to Asia or something like that. But in terms of the overall economy, your vacation overseas is not that important in terms of the global economy. So trade deficit and more debt. So more debt really isn't all that likely going forward. We're likely going to see a drawdown in debt, not a huge one, but one that's moderate. And a large part of that is the roll off on the Fed's balance sheet. The bonds that they hold, they're allowing them to mature. They're collecting those principal payments, and they're basically just keeping them there, probably to increase liquidity at a later date. Also, let's remember that pandemic spending ended in March of last year for the most part. And we've seen about a 20% reduction in spending by the federal government. Yes, 20%, one of the largest reductions of spending. And it's only because we had one of the largest increases in spending before that due to pandemic spending. But we've seen an enormous, there's basically this enormous sucking sound in the economy right now where spending and money is being drawn out. And it's not necessarily in order to control inflation, but really about the end of pandemic spending. The bill that was passed, the Build Back Better bill, which is being blamed for a lot of things, including inflation. I hear illogical arguments on this all the time. Yes, it's a $1.7 trillion bill, but that is a $1.7 trillion spending bill that is spread over the next 10 years. So roughly about $170 billion a year. Even when that is calculated in, we still see a reduction of 20% spending by the federal government this year. So we're still spending more than we're bringing in. That's a fact. The deficit is going to, the actual government's debt is going to increase, but at a much slower rate than it has been before, and combined with the balance sheet roll for the Fed as well. What is the Fed going to do with that money? I think they're going to sit on it to re-stimulate the economy if they overshoot the mark and actually throw the economy into a deep recession, which they've tended to do in the past. It's been overreaction to a degree that has precipitated our last couple of recessions. Not necessarily 2008, but I'm talking about the recession, the dot-com recession, and the recession in the early 1990s. So, is there a way to tell what's influencing inflation most? Gas prices versus money printing. So, look, money printing. This is counterintuitive. But money printing at this point is likely not the culprit. And if you look at money printing versus inflation in the past, there hasn't actually been a direct one-to-one correlation ever. And there is, when you look at more globally at societies in the past, that money printing has been the main cause of inflation over time, main cause of loss of influence around the world. But in the case of the United States, this hasn't actually been true. It's usually been caused by supply shock, with gas prices, fuel prices, energy prices rather, being the major culprit for the inflation event between 1973 and 1982. That was what set up the sort of positive feedback loop. Definitely did that. But we are also looking at a time period now where our supply chains are a lot more globalized than they have been. And the Fed's has more limited powers to a degree when it comes to just controlling U.S. monetary policy and how that can affect global inflation. Right now, it doesn't matter if the U.S. really cracks down on monetary policy. We're just now seeing the European Central Bank do that. They just finally went to positive interest rates after more than a decade of negative interest rates. And we're just now seeing them do that. So the Fed doesn't have as much influence over global inflation rates as they did in the past. And that's largely because our economy is more internationalized. They don't have any control over supply chain snarls that are making it difficult to get products here. There's high demand for products here, and it's making everything more expensive. So what is the future of the EV? Are they much more costly to manufacture? Much more. Actually, they're not necessarily more costly to manufacture. If you look at per vehicle margins on like the Tesla Model 3, they're actually huge. And this is the reason that almost every EV company is switching, or almost every car company says that they're going to have an electric future, right? They're not necessarily compelled to do that by the government in many cases. They're encouraged to do that pretty heavily in China with subsidies. They're encouraged to do that in the United States and Europe with subsidies. But it really has to do with manufacturing margin. There's going to be a lot more margin in look at scale of production here. Basically, Tesla produced just under 1 million vehicles last year, and their margins look comparable to GM. And GM produced about 7.7 million vehicles last year, right? So when you look at economies of scale, there should be a much larger margin for producing almost 7 times, or a little bit more than 7 times the production, or almost 8 times rather, the production of Tesla. They should have had better margins out there. They don't. For a couple of different reasons. Number one, they spend billions of dollars on advertising, which Tesla doesn't. But it's actually manufacturing margins that are going to, and they discovered this right around the 2017, 2018 timeframe. And all of these manufacturers started talking about a pivot to EVs, and it's all about margins. They're going to make more money by producing electric vehicles. And it's not going to be the highest end electric vehicles that are going to make them the most amount of money. It's going to be the daily commuter that's the right size for the market that it's being sold in, that has the right amount of range, and that has the right amount of bells and whistles. It's not going to be the high thing. The high price car, high margin vehicle sold to a select amount of people. This is how Tesla kind of got their start. Other companies are not going to be able to follow in that exact same path. They're going to have to take a slightly different path in order to get ahead. So new person here. I don't know if you're still on the live stream here, but I wanted to say hi. You're a new person, and let's talk about Microsoft. So the last downturn in 2020, when Microsoft absolutely got crushed in April, May of that year, I ended up buying a leaps option on Microsoft expiration at just over a year. I think it was 13 or 14 months. Leaps option is just a deep in the money call with an expiration of greater than a year. I think I ended up turning around close to about 150% on that investment. When it comes to some of these really well-established players, leaps options are something you might want to think about right now if you have the available cash, rather than jumping into the stock. And I'm not even talking about necessarily like buying leaps at Tesla. I barely escaped with my life on a leaps option on Tesla earlier this year. I intended on holding it for a year, but then everything kind of went to crap, and then it jumped back over the strike, or not the strike price, but jumped back over my cost, and ended up selling at that point. But typically, I want to hold these for a year so I get long-term capital gains treatment on that. There is tremendous opportunity in financials looking at leaps right now. There's tremendous opportunity in mega tech companies like Microsoft and Google. I don't know too many people can afford a leaps option on Google at this point, but you probably can on Microsoft. So after the split, you can probably afford leaps options on Google. So, but yeah, the future of EVs right now, they're not much more costly to buy than a regular car in the same class. If you look at a Tesla Model 3 total cost of ownership versus a Toyota Camry total cost of ownership, you'll see that Toyota Model 3 actually has a lower total cost of ownership, a little bit higher sticker price to begin with. But I think the average price of a vehicle in the U.S. crossed the $50,000 mark sometime earlier this year. So, yeah. Let's talk about this. If gas prices are primarily causing inflation, so I don't think that gas prices are primarily causing inflation. It's supply shock at this point. And yes, it is going to be an argument against that's going to be an argument against globalization and long supply chains. And I think that there's an avenue for high dollar, high margin, pretty far up the chain in terms of complexity. There's an argument for reshoring a lot of that production. but you aren't going to see things like t-shirt manufacturing reshored to the United States. All of that textile work is going to be done in the Dominican Republic, in Pakistan, in China. It's going to continue to be done there because that is such a well-established industry that we're not going to be able to increase margins enough here to make up for increased labor costs, even with automation. But yeah, I think that I think high gas prices are less of a concern for globalization rather than just the exposure of how complex our supply chains are. We had a relative disruption every few months in supply chains due to COVID shutdowns, maybe like 9 to 11 months total, where we had like massive shutdowns in China. And we're going to see the effects of this for years. There have been other historical cases of small events affecting supply chains for years. And this is not necessarily a tiny event, but there was a guy from the Kingdom of Ghana who did a Hajj. He went from the Kingdom of Ghana all the way to Saudi Arabia, and Ghana had just gold. They had a trade. They had a trading system where they were actually buying salt from traders from North Africa and exchanging it for gold. He did this tour through North Africa and basically made it rain in terms of gold. And that caused an inflation event that lasted for almost a century. Right. It lasted for almost a century until the markets tended to normalize. I'm not saying that our supply chain issues are going to last for a century, but what it's going to take is normalization of the business environment in China. And the answer that no one likes to hear is it's going to take time. We are stuck with inflation. And even with interest rates rising here, I think that, and even with the optimism that inflation has peaked, it may have peaked. I don't know. It actually kind of seems likely that where we're looking at the R squared on inflation right now, it's actually been decelerating for a while now. So at least the rate of increase is decelerating. I don't know that it's peaked, but at this point, it's just going to take time to repair all of those. So, yeah. I think that it's seeding money supply causes inflation, money printing, higher gas prices are in the Fed's favor. It does eventually, but in this case, we aren't looking at, if you look at the velocity of money, which is probably one of the greater indications of how inflation could be affected by money printing. The velocity of money is essentially a measure of how often a single dollar changes hands in the economy. And when you have an inflationary economy in most environments, the velocity of money increases really quickly. The problem is this time around, the velocity of money is really, really low. In fact, it's at a generational low and hasn't been as low in a long time. What people did with the excess money they had because of what went on in the pandemic is they shored up their savings accounts, they paid off a lot of debt, or they invested it in the stock market. So it is not circulating in the economy like it would have in the past. If you look at the stimulus events that happened in 2001, and I think it was all in 2001, that caused a momentary increase in the velocity of money. That didn't happen with the pandemic, and I think a lot of it had to do with uncertainty. But a lot of households took that money and used that to improve their picture. They didn't go out and buy things like we thought they were going to do, like just massively stimulate the economy. It's mostly middle class and upper middle class people that use this as an opportunity to pay off debt. And folks lower on the economic scale definitely went out and spent money, but no, the evidence doesn't support that. But if you look at a country like Greece, countries like Greece, Italy, Portugal, Ireland, prior to 2008. I do think that one of the reasons they had such problems with their debt is they were no longer in charge of their money supply, and they weren't able to start printing more money in order to basically create liquidity in their economy. And that's one of the things they gave up when they joined the European Union or they adopted the euro as a currency. They no longer control their monetary policy. That's done by the European Central Bank. But yeah, so look at actually the history of money printing. And absolutely, it does cause inflation. Absolutely, it does. In this case, though, the evidence isn't there. And it really has to do with the velocity of money. It's at a generational low at this point. And look at other inflation events in the U.S. economy. We had a massive decrease in inflation in the 1980s when we expanded our debt Um, I don't know how many fold. It was like 1,000% in 10 years that we expanded our debt load. We basically exchanged high inflation rates for national debt in the 1980s. That was essentially the solution that Paul Volcker came up with. He made the dollar itself less attractive as an investment and made treasuries being issued at 18 and 21% on a 30-year basis a lot more attractive, which helped to end inflation. But it also we made this compromise where we were the solution that nobody wants to do is spend less money and pay off the debt. Mansa Musa, yes. Michael Will says Mansa Musa was the one who crashed economies by gifting gold. Yes, he devalued gold worldwide. I couldn't remember the name of that guy, but I think it was actually Ibn Khaldun, the historian, the original historian who brought that sort of story to light. And there were other supporting documents in that time period. It's actually it's well documented. So Ibn Khaldun, in a lot of ways, is kind of the father of modern anthropology. In a lot of ways, he was doing things that that modern anthropologists do, but he did them centuries ago. And yeah, let me see here. Hal, we have another question here. First stream of the week for me. Do you think that the tech businesses like Shopify can fix up the cost side of the business without killing growth? So Shopify is a stock that I don't own, and I sold out of Shopify a long time ago, probably back in February. And I don't like to sell stocks because I don't like to pay taxes, but it reached a valuation point where I thought it was kind of ridiculous. I have some experience with Shopify stores. I kind of looked at their numbers. A huge percentage of their stores fail outright. It's usually between 70 and 90% in any given year, which is not that much of a concern because that's sort of the failure rate of businesses anyway. And the stickiness of their business actually works fairly well. Their platform is priced really competitively. I do think they can continue to grow, and they make e-commerce just really, really easy, particularly now that they are paired up with a bunch of people that do like automation and a bunch of people who do like drop shipping. I know that drop shipping to an extent is kind of dead. I'm talking about the Alibaba Express kind of deal. But there are a lot of other businesses that they're making like really easy to automate. So I do think they're going to come back. I do think that their profits are going to be affected by of course, what I talked about earlier is increased labor costs, and it's going to take time to pass it on to their consumers. And their consumers are the people really that pay to have their stores on that platform. I think Shopify is really an interesting story. Like I tried to do something similar to Shopify back in, I think, 97, 98, 99. And that business failed eventually because we didn't make it easy on people. We did all of the development for people in-house. We ended up charging them a large fee to do their store development. And then getting payment services and all that was really onerous back then. So doing business on the way they've done it is they made everything absolutely simple. And Shopify is really going to become the destination, or it already is really the destination for small online sellers who don't want to pay the giant commissions that Amazon is charging. So your store's a little bit harder to find on the Shopify platform. Your products are a little bit harder to find on the Shopify platform than they are on Amazon. But yes. Axon is absolutely on my recovery stock list. If you don't know who Axon is, virtually all of the body cam footage you're seeing right now from police interactions is on Axon cameras right now. They have a lock on the market right now that's not necessarily going to last, but it's their involvement with evidence.com that is really going to power the business in the future, I think. So evidence.com is basically a warehouse for evidence and the artificial intelligence, search engines, the ability to make connections, all that stuff that law enforcement agencies are going to be using on a subscription basis. That is going to really power what they do in the future. They're also involved with like drone tech. Oh, wow, dude. A hawk just got a bird in my backyard. That's crazy. Anyway, and that's actually kind of not an infrequent thing that happens in my backyard is hawks getting dive bombed, or hawks dive bombing birds, or last year it was a kitten. Anyway, but Axon is definitely on my list as a recovery stock. Their earnings and growth look pretty good. I haven't looked at them in a while. So let's see what they look like here. And let me see, Axon Enterprises Inc. We're going to look at revenue and growth here. All right. So we're looking at total revenues, steady growth for this company, which is a very, very good sign. They've basically grown almost every quarter for the last decade or so. The price is about $98 a share. I think it's down a little bit from where I looked at it. Let's go back here and hold on a second here. Let's go back and look at some financial analysis here. Cash flow is going to look pretty good in this case. We're going to look at basically year to date here, but Axon is definitely in there. So I don't know if the merger issue is resolved with Axon or not. Cash from investing, cash from financing, charge supplemental items. Okay, now it's asking me to upgrade. I guess they finally started to take away some of what oh no, okay, so it's filling in. It's just slow. Depreciation, amortization, cash from operations. So stock-based compensation is one of the things I'm looking at more closely now. So I don't know how the makeup of their management looks, and a lot of times that's who gets a lot of the stock-based compensation. For a company this small, it's actually pretty large. But if you look at the stock price and the growth of the company, I would say that some of that is going to be justified here. Cash from operations looks relatively stable, although we are seeing a little bit of a dip here for first quarter in 2022. A little bit of a dip from previous months here. But no, this company actually looks fairly good. Let me see here. Let's look at the performance of the stock in the last couple of months. This is not one that I own, but has been on my radar for a while. I cannot own everything that I like. But yeah, let's look at price and volume here over the last couple of months. And let's look at year to date. Year to date, it's down, of course. Let's look at the 1 year. It looks like it hit a high water mark of roughly $192 a share in August of 2021. So it's down close to 50% from that point. It's still showing solid revenue growth on a year-over-year basis. That doesn't look to change anytime soon, especially with all of the technology or all of the money being put into technology at this point. So, and tons of law enforcement technology. So yeah, so a lot of things on my list here. Dutch Brothers is one of the ones that I talked about earlier. So I've talked about this company a couple times on my channel. This is not a company that I hold as an individual stock. It is getting to the point now where I want to start taking a look at owning this as an individual stock. I used to own this years ago, and I'm talking about Walt Disney. A lot of it has to do with the properties that they hold and the fact that their streaming service is now really in competition with Netflix, right? So we have seen a decrease in revenues since 2020. And of course, that is the massive amount of signups they had because of the release of certain Star Wars properties in that time period. And of course, the pandemic. We've seen declining revenues since then to a degree. And I think that is understandable. People don't necessarily buy a streaming membership forever anymore. They switch between networks when they have properties that people want to watch. The two properties that Disney controls that are huge money makers are, of course, the Marvel Cinematic Universe and Star Wars. They're going to be able to continue to produce material on that year after year. Even if they slow it down, it's going to be a massive moneymaker for them for a generation to a degree. So we are looking at losses for the first time in a couple of years here. I do think, though, that this is kind of when you want to get into Disney. The last time I thought about getting into Disney was around this time period, 2017, 2018. But I ended up not pulling the trigger on that, missed out on all of those 2020 gains. To be honest with you, though, I don't think I would have had the foresight to sell that. Back then, I was probably convinced that the relationships that people had with their streaming networks were a bit more sticky, since I know people that have been with Netflix for years. But now people seem to be bouncing around. One of the big things going forward, of course, is Amazon Prime and all of the shows that are being produced on Amazon Prime. And that is one membership that people don't seem to get rid of, largely because people are running more and more of their life on automatic shipments of consumer staples, which automatically gives them access to Amazon Prime and certain videos out there too, and certain shows. as they start developing more and more of their own properties or acquiring different like story universes, I think that Amazon's business in entertainment is just going to grow and grow like a monster. So Walt Disney is definitely one of those that I'm taking a look at, still not entirely ready to pull the trigger on that. So yeah. Wow. So what do you think about EDR stock since it owns the UFC? So that's an interesting question, though. So I'm not sure how interested the UFC is in returning shareholder value back to its parent company. That's one of the things that I worry about. And I don't approve of how fighters are paid on the lower scale. Like I've known numerous, and I don't want to name any names here, but I've known numerous people on the lower end of the scale who fought 2-3 times a year for the UFC. They never quite made it big, but what they got paid was almost criminal compared to what they would have gotten paid as boxers. Like growing up, I knew a lot of boxers who had records like 19-10, 24-20, or like 30-16. And these guys were getting paid $30,000 to $50,000 a fight, and this is 20 years ago, for $30,000 to $50,000 a fight for anyone in the top 20 or so. And yes, they were used as tomato cans to some degree. And once again, I'm not naming any names, but they were able to make a living at being a boxer. Your average UFC fighter, they're not able to do that. I anticipate labor issues with them to some degree. I anticipate that their competition is actually going to get better and better and better. But also, it's just, I'm not sure they're interested in returning shareholder value. And that's kind of one of my main concerns with EDR. So I like Disney because I think it will be a big player in the metaverse. I do too. And that's something that I haven't put a lot of thought into, other than thinking, hey, they're probably going to be a big player in the metaverse. There's a big nostalgic element in there, and putting their characters and stories that you can interact with in the metaverse. And I'm not just talking about things that have been done recently, but they can reach all the way into the past to more than 100 years of material to sell nostalgia. And that's one of the reasons that I like Disney. I think they're going to spend a lot of money on a pivot into the metaverse. But yeah, I do think that is coming at some point. So, of course, the big one that I see on the list that Nancy Pelosi's husband is in total agreement with me is Nvidia. But here's my thoughts on Nvidia. You have to be prepared for volatility. Every single option strategy that I have tried on Nvidia has blown up in my face, and I've had to unwind a bunch of options that I sold on Nvidia, largely because I didn't want to pay taxes on the large amount of gains I have in the stock, and the fact that it's just so volatile that it's really hard to design an option strategy that, other than a collar, that's going to work for you. And I don't like collars because of how many taxable events they create around the stock, and the fact that when you create a constructive sale at the end of the year, by doing that, sometimes you have tax issues. So with the $50 billion bill or so looking to make it through Congress and the Senate here pretty soon, it looks like they're going to have a pretty large incentive to reshore some of their production here in the United States. They're a leading GPU maker. They're also deeply involved in artificial intelligence, autonomous driving. Cloud computing is a big deal. They're involved in the medical industry. I think a decade from now, this is going to be one of the, if not, it may comprise the largest component of the S&P 500 a decade from now. And I always say I'm not in the business of predictions, and then every day I make a prediction, but I think it's entirely possible that a decade from now, Nvidia is the largest company on the S&P 500. It's an insanely profitable hardware company. Return on equity over the past year or so has been really high. Net margins are around 32%. And these are like numbers from software companies, but on a hardware stock. So I do anticipate that some of those net margins are going to increase if they reshore some of this business. Of course, I do anticipate that the demand for GPUs is going to decrease, but their business in other branches, their other lines of business is just going to increase, especially when it comes to things like molecular modeling. That's not something that you think of a lot, but there are a lot of companies that do molecular modeling that are on the cutting edge of chemistry and genomics and things like that. They're using NVIDIA's products right now. Their shares have basically been more than cut in half since 2021. somebody predicted earlier this year that on my channel that Nvidia could drop to $150 a share. I was skeptical. I was wrong. It got down to like $150 a share, and I was only able to afford like 2 shares that day, but I ended up buying what I could. But I am slowly acquiring Nvidia shares at anywhere under $200 at this point, whenever I have the funds available, and that is not, that is not opposite. So, let me see here. Thoughts on cybersecurity stocks, and would you look more at established like Palo Alto or earnings negative market leaders like Zscaler and CrowdStrike? So I'm still doing my research on cybersecurity stocks. I do have access to people pretty high up on the food chain in cybersecurity. And I do want to have some more. I haven't had the in-depth conversations with these people like I should. I've been doing some research on my own, but pretty soon I'm going to start setting up some of these conversations. But look, in terms of creating a profit in the next year or two, some of your more established players are probably going to be a bigger bet. You can magnify that by buying leaps options instead, meaning you're using less of your purchasing power to buy leaps options on these stock deep in the money, folks, to lessen your chances of failure. You are using leverage there to eke out more return. In terms of Zscaler and CrowdStrike that are earnings negative, I still think these are pretty good companies. They have a pathway. Both of them have a pathway to profitability, but I do think that you just have to reprice what their future cash flows are worth based on current or predicted interest rates. And I predicted interest rates are going to get fairly high in order to tamp down demand. And we're probably looking at a scenario where unemployment increases to over 6%. Unemployment increasing to over 6% is essentially the economy looking like it did in the mid 1990s, which is not bad at all, folks. That is not bad at all. It's just higher than we've been used to when it comes to unemployment for the last 6 years or so. This is not a devastating high amount of unemployment unless you're one of those people that's unemployed, of course. But no, I do think that the established players are a better choice for this market for a lot. If you particularly have gotten burned on a lot of these cash negative tech companies right now, I think that some of the larger, more established tech companies and using the sort of no recourse leverage like leaps options might be better for you. So I've had Enphase and Honest on my radar for a while. What do you think? So let's take a look here. Enphase Energy. Let me see here. Price and volume. And I'm going to bring up some additional information on Enphase here. All right. So when I'm on a live stream, folks, my download speed is kind of affected by that. So I'm going to take a look at Enphase, and I'm going to get here. All right. So we're going to look at price and volume. Of course, it's loading market data. Sorry about that. So we're going to look at 1 year. The trend line has basically been flat with a lot of volatility in there. It's a lot of volatility in there. Let's take a look at financials here. Financial analysis. Profitability is the thing I want to look at here. We're going to look at the last 12 months or so. Yeah, my internet connection is not cooperating today, folks. So yeah, I'll try to get that as we can. And these numbers will fill in as we go forward here. And it's looking back, of course, a decade. So I'm going to take a look here. But look, right now, for a lot of these companies, you should be evaluating things on Michael Will. I'm going to talk to you about your question here in just a moment, and you're probably going to be moderately surprised by my take on this here. So net income margin is 10%, SG&A margin is 17% for first quarter. Yeah. Gross profit margin is 39%. Margin here is 17%. Return on equity 30. Well, these are like software margins for Enphase Energy here. And for this company in particular, Also, we're looking at rising profits and beating expectations for the last 4 quarters. We're looking at growing revenues. Profitability is not necessarily growing all that fast, but growing revenues from just in 2018, roughly about $30 million up to $1.4 billion. But yeah, so they design, develop, and manufacture home energy solutions for the solar voltaic industry. They mostly do your converters there, and their business has been increasing. I would need to know a little bit more about what else they're doing in the energy market, although their revenue growth looks really good at this point. So, and their return on equity looks really good too. So, but yeah, I do think Enphase is a fairly good investment. I've looked at it a couple of times. I do think also though that you need to the actual price itself is high. I would like to see that come down a little bit more. I want to see a sort of reevaluation of what the value of those future cash flows looks like, especially if their profitability does not increase along with their revenue. So, yes, can you explain the relevance of midterms to investing in U.S. stocks? I know this is going to come as a surprise to most people. There is no relationship between elections and the stock market. That has been true for as long as there has been a stock market and elections. We tend to see a one-day panic around elections, and that's it. So you can go back and Google, and I've done this. I did this recently. You can go back and Google recession every single year: recession 2020, recession 2021, recession 2019, recession 2008, and then Google recession in conjunction with any single candidate who was ever elected, and you're going to see that everyone predicts recession anytime anyone is elected. Everyone predicts recession every single year. It doesn't happen. So people are more often wrong when it comes to predicting recession, particularly when it comes to which party is going to be better for the stock market. Most people have that incorrect. There is one party where the stock market performs better under this party, and it's done that for 70 years. There's one party where the private sector incomes are higher, where we see private sector employment being better, where we see GDP growth being better, and that I'll let you figure that out for yourself. But you can Google which party is better for the economy, and you're going to get one answer. But then you Google the actual numbers, which is GDP growth, private sector employment, unemployment, stock market growth, and basically it paints a different story. So is it a one-to-one correlation? I don't think so. Is it a simple question or simple answer? I don't think so either. But elections really don't have an impact on what the market does at all. It's really the market does what the market does. So the government can certainly ruin a market, and they've done that in the past, but they can't really improve the economy in the ways that we think they can. So, yeah. So, Robinson Lee says, "Love the show. Thanks for your inputs." Thank you. Some days I don't get a lot of input on my channel. Today I'm getting a lot, so I'm pretty happy about that. I like to get a lot of questions from you guys. I haven't even gotten a chance to go through all of the stocks that I like here. Did want to talk about things that right now might not look so great. And this is one of those where I've never owned this company as an individual stock before. I'm talking about Lowe's. I am likely to purchase a leap option on this stock pretty soon, largely because of how much it's absolutely gotten crushed in the last year or so. We saw a peak of roughly $258 a share. We saw a trough here of about 171, and today it's about $188 a share. I think that as the bottom further drops out of home construction, and I think as interest rates rise, and especially as accessing the equity in your home gets more expensive because a lot of those home equity lines, or almost all home equity lines of credit, are based on a variable interest rate, and those interest rates are going to rise precipitously, far above what it is for a 30-year mortgage. I think you're going to see home improvements kind of drop off pretty precipitously. So at some point in the next year, as we see kind of a low develop in the housing market, then I'm going to buy leap options on Lowe's, and I'm going to price them out at about 18 months to 2 years, right? So I'm willing to sit there and look at red and losses in my portfolio for 18 months to 2 years, knowing that, not knowing, but I mean, turning 100% profit on a leaps option for waiting for 2 years is not uncommon, guys. It just isn't uncommon. And you do this with like real quality stocks. So this is a company that's pretty well insulated from recession right now. They got a market value of about $110 billion. It does pay a dividend yield of 2.4%, but if you own the leaps option, you're not getting that dividend. Do I want to enter into the stock right now? Maybe not. Do I think there's a lot of home improvement coming in the future? I do. Here's one of the weird things that's not really quantifiable right now. A lot of millennials have bought homes in the last couple of years. A lot of these millennials lived in apartments for years where maintenance was taken care of for them. Now, for the moment, accessing a home equity line of credit is getting more and more expensive, but at some point, that decreases again when the government or when the Federal Reserve tries to re-stimulate the economy. Interest rates are going to drop. And at that point, all of these millennials that purchased these homes from, say, 2018 to 2022, now they've built up a lot of these self-improvement skills. Now they're going to be looking to start using Lowe's and Home Depot products again. So both Lowe's and Home Depot, I think, represent not rock bottom value right now. I think there's a little bit of time before that happens. But Lowe's is also a dividend aristocrat. So meaning that they've raised their dividends for the last like 20 years in a row. Actually, they've got almost a half a century of uninterrupted payouts behind them and raising that payout every year. So if you want on a bet on like a second half rebound of the year, I don't think that's going to happen. I think the rebound actually happens probably in 2023, and it's going to put a dividend in your pocket as well if that's something that you're interested in. And same thing with Home Depot. And I like Lowe's a little bit more. I tend to shop there more. But in terms of market value, the market cap for Home Depot is like $270 billion. They have a comparable dividend yield of about 2.8%. They are rivals, yes. They do a few things more differently. I tend to prefer Lowe's, but I can't think of why I prefer Lowe's more than I'm just used to the layout of Lowe's rather than Home Depot. But honestly, I think in terms of investments, they are roughly equal. If inflation is your worry, then and high mortgage rates come with that, it's going to delay people from doing their major renovation projects. I would wait until we get a top in interest rates from the Federal Reserve to see this. So this is actually probably the number one investment that is not really obvious right now. And I'm going to talk about that here in just a minute. This is the number one stock that I'm looking at right now. And I don't know if I said number one earlier. So yeah. So Hal says, hold on a second. Hal says, I've had Enphase since it was $7. Solar is big in Australia, so I had early exposure to the product. So Enphase was actually brought to my attention last year by someone on my channel. That happens frequently where someone brings me ideas on my channel. These are not necessarily ideas that I come up with on my own in terms of investments. I haven't dived into this yet. I really like to know a company better before I do, but I think I'm actually going to take a harder look at that. I do like what I'm seeing here. So I'm looking at MasterCard and Toll Brothers, best to wait or dollar cost average. Particularly when it comes to MasterCard, start dollar cost averaging your way in right now. That's a company that I think represents deep, deep value. So let me see here. Sorry, Mid-America Apartment Communities. I'm sorry. Yeah, so Mid-America Apartment Communities is a company that I don't hold as an individual investment, but I hold it through an ETF that I hold, which is RES, RES is basically a REIT of REITs that basically just holds residential REITs. And that is, I'm interested in holding residential properties right now. A lot of people, because of the increased cost to borrow money, are going to be forced to stay in apartments or other rental properties. With all of the institutional buying right now in some really expensive markets like Austin in May, it was either April or May, 41% of single family homes were sold to institutional investors. I do think that at some point that's going to be commoditized into a REIT of single family homes, like rentable single family homes. I want to see what happens with that, but that's something that I'll be looking to buy into as well. Real estate, I'm not really big on probably buying more outright rental real estate at this point. I probably want to do things through REITs. I don't enjoy being a landlord or dealing with tenant issues. It takes up a lot of time and you don't really get paid for it. So, and my time is valuable. But yeah, I would definitely start dollar cost averaging in to those companies right now. But I don't think you necessarily want to wait too much. As housing prices start to crash, you're going to see a pretty big influx of money into these apartment REITs as people start to realize that if you're a renter before the monthly cost of your mortgage went up by 40% to 60%, you're going to be a renter now. So my nephew loves going to Home Depot for the kids' activities. Man, when I had my first kid, we were dirt poor. And that was one of the favorite activities I had with my kids too, is going to Home Depot for the little toys they give away where, and you build them just on the tables there. I had a great time doing that. So yeah. SoFi investment, I still own close to 7,000 SoFi shares. I'm still bullish, but worried, of course, as well. I also realize that everything fintech related has just gotten absolutely punished this year. SoFi really hasn't done anything wrong, and their story is still absolutely a growth story. They are growing their membership, they're growing their revenues, and their margins are increasing. But they are facing headwinds from the market. And of course, just severe headwinds. Look at PayPal. PayPal is down 75% off of its highs. There is no reason why SoFi would have been immune to that. Their pathway to profitability is still right around 2024 for me. That's when I think the company is going to be profitable. That's a company where I struggle. Like, I own a lot of shares, so I'm not sure if I want to buy any more. But no, my average cost has now been brought down to around $15 a share, which means I am presently losing my butt on this investment. Although I don't have any desire to sell at this point. It's likely to come back in the future, just because cash flows are going to support it in the future, and that's kind of the issue. If cash flows still look good, growth still looks good, and there doesn't seem to be any stumbling path in that, meaning that do they have? There basically doesn't seem to be a stumbling path in the way. Then I haven't changed my mind on most investments. The ones that I had the most doubt over are the genomic stocks, largely because there isn't really a way to evaluate their growth prospects. There isn't really a way to put a value on their future cash flows either. So everything is basically just speculative when it comes to genomic stocks. This is why I choose to just slowly dollar cost average my way into onto ARK's genomics fund. So yeah, that's kind of one of my main things there. So next up on the list is the number one thing. If you are into real estate, this is probably the number one investment you should choose. This is a generational winner. And I have to, because I said should choose, I have to state this is, of course, not a recommendation to any individual to go out there and buy and sell an individual stock, because I can't do that on a YouTube channel. But I'm talking about Prologis. Prologis is it's a logistical real estate company that supports e-commerce. I think that it's absolutely unstoppable at this point. It is a real estate investment trust. It is priced about right at roughly, actually, let's just look that up. So let's just look that up right now. It's a PLD, sorry. PLD. Basically, it's a company that runs warehouses for e-commerce. This is one of the things that they really concentrate on. If you look at the value right now of a single share of stock, it's about $127 a share. It's down precipitously from August of last year when it was 144 or 150 something dollars a share. It hit a low of roughly $113 a share, and it's back up a little bit to around $127 a share. Dividend yield is pretty juicy for a REIT right now at around 2.3%. Particularly, this is just a warehouse REIT, and the total market cap was about $81 or $82 billion. So, we mentioned Amazon earlier this year. It's unstoppable, but I think that even if you don't want to bet on Amazon, betting on warehousing space for e-commerce is a pretty safe bet. But it specializes in exactly those special types of properties. They operate about 4,600 buildings with over 1 billion square feet of space. And it's about to get even bigger since Prologis just agreed to acquire its largest rival in the industrial space, which is Duke Realty, which trades under DRE. And unlike another mentioned merger or purchase that I'm not going to mention again today, that's likely to happen. So the shares have struggled in 2022. They're down about 35%, but a REIT tends to be very interest rate sensitive as well, and the Fed's aggressive rate hikes haven't helped. But you should be, but if you look at the dividend yield where it was a year ago, it was a lot smaller than now. And if you're looking at investing in something on a 10-year basis at 2.9%, you are really close to what the 10-year yield is on treasuries at this point. And I think this is really a best-in-class REIT that's poised to recover. I think turning around and making a quick, literal 50% over the next 2 years is entirely possible. And it's possible to get paid a fat and rising dividend while you wait. But for me personally, I'm going to buy into the stock and keep the stock pretty much forever. I probably won't get rid of it at any point. So one of the things that's absolutely going to get hammered is going to be retailers. There's a number of retailers on other lists that people want you to invest in, like the Gap and I just can't think of the other ones off the top of my head. That's not what I'm talking about. I'm talking about the Walmarts that just got crushed yesterday and today. And I'm talking about like Target as well. Target for years kind of struggle in the face of competition, but they've really found their footing in terms of how they market, in terms of who they target and all that stuff. So Nelly Furtada says, SoFi's product is good. I use it in my secondary bank. Actually, I'm using SoFi now as my primary bank for banking at this point. It's only going to get better as more products get integrated. The only reason I haven't switched over entirely is because I do a lot of business banking, and they don't have the best services right now for businesses. So that's what I'm saying. So Michael Will says Amazon has rented too many warehouses in the UK and are subletting. That's what spooked the UK market. But Amazon isn't the only e-commerce company out there. And maybe they have overexpanded in that area, but it doesn't mean that other people, if they're able to sublet it at all, it means that there is demand for that in the market. So one of the things I brought up today in my Patreon that I want you guys to take a look at here is this. And I don't know if you guys can actually see this. I'm looking at interest rates here. This is actually a really concerning sign for, let me see if I can increase this. I don't want it to get too blurry, but this is actually a concerning, this is a seriously concerning sign for the stock market. So the stock market, there's a lot of people over the last decade or two who've gotten involved in the stock market who in prior periods would never have gotten involved in the stock market. They don't like the risk. They cannot stomach volatility. And this is the danger right here. A 9-month CD is right now is at 2.75%. A 1-year CD is at 2.9%. There are millions of people that own stocks right now, even stocks that pay dividends, who'd rather own a CD. They see their safety of their money and the little interest they earn as being, they make a conscious choice. They're more comfortable with safety than they are with taking risk in any degree. And I worked at a bank brokerage, and there are millions of people that have been forced into the market because there's been zero yield in the last decade and a half when it comes to anything in the fixed income market. That is changing. We're coming off the worst year in fixed income in history, and now yields are starting to look juicy. A 1-year CD at 2.9% is enough to suck a lot of people out of the market. A lot of older people that prefer safety over the possibility of earning more money. A lot of people cannot fathom the amount of risk you have to take to get a 7.5% return over a decade. They just can't fathom it. The first time the stocks are down 20% or so, they're going to sell out, eat the loss, go back into CDs. That's what's going to happen. And it's going to mute the recovery to a degree in terms of stocks. I mean, some of the money is going to leave the market and it's not going to come back, right? Tommy Flanagan says, you're right. It doesn't cover inflation. The problem is people don't make rational decisions. I'm saying this with a great deal of experience to back this up and a great deal of data to back this up. People do not make decisions based on anything rational. I can tell them outright that with the inflation rate at 9.1%, plus the taxes you pay in a CD outside of an IRA, you're losing purchasing power, and not just a little bit. You're using a lot of purchasing power, meaning that between taxes and inflation, your 2.9% that you're getting over a year means that if this continues for 10 years, you're going to lose half of your purchasing power. They don't care. They cannot see that far in the future. They can't do that math calculation, and they don't have a way of quantifying risk that makes sense to them. So Tommy, and like I said, this doesn't make sense to you. Congratulations. You're someone who's an investor and not a saver. There are millions of people in the stock market right now who don't want to be there. They never wanted to be there. They felt they had no choice due to interest rates. So Sparked Interests is a frequent guest on my live streams. Did want to say hello today. Thank you. As a customer, I prefer AMD over Intel. Although I believe that at this point, Intel has a better valuation. There's a geopolitical need to manufacture chips in the U.S. Yeah, I mean, the chips bill that is out there right now is 100% motivated by geopolitics. And I know that they're saying there's a lot of good paying jobs that are coming here to the U.S., but honestly, it's 100% motivated by geopolitics. In the event of a conflict that the United States, not necessarily with China, but with somebody that China doesn't agree with the U.S. being in a conflict with, we could see our supply of chips disappearing. So, yeah. So what happened to BBAI? Why is it so low now? So there is not a ton of information out there on Big Bear AI. There is not a lot of press releases out there. There is probably not a reason for the stock to have ever gotten that high to begin with. This is a company. It's not a unicorn. They've been in business for a long time. They've been profitable for a long time, and they've taken all of the money that they gained from going public and have invested that into expansion. But right now, it's pretty much fairly valued. So I bought some on speculation earlier this year and ended up selling out. I still hold a bunch of that stock, but I'm purchasing it. Well, I haven't made a purchase in about 2 weeks or so, but now I think it was about $2.80 a share. And I can't say much more about this because I do have a personal connection to this company. And I don't have any information that's not public, but I am aware of what they are working on in the government sphere. And I will say that the amount of contracts they have going forward and the amount of business they have going forward is going to ensure that their revenues grow for a very long time. Does this represent value? You cannot really say that about a company that's priced this cheaply, or a company whose market cap is this small or volume is so low. It is entirely speculation at this point. So it's speculation that I think is better backed up in this case than it is for a lot of companies we talked about last year and the year before that. But Big Bear AI is going to be a risky stock for a number of years until we get more volume in that stock, until we get a clear idea of how they're going to market themselves in terms of the private market. But in terms of their government business that they have going forward, their contracts signed but not fulfilled are enough to keep them growing at a 20 to 30% rate for years and years to come. So, yeah. And if you're tempted to buy some, though, of Big Bear AI, which trades under the symbol BBAI, I just want to warn you, though I own some. I own it on pure speculation based on the people that I know involved in the company. Yeah. Steven says, how can we have a live stream without talking about NEO? Okay, let's talk about NEO. For two reasons, I've had a kind of a big shift on my thinking on NEO, and I am going to more aggressively price my options here in the future, and meaning that I am probably looking to exit that stock for two different reasons. Number one, the risk of delisting is growing. Now I know that negotiations are going on, but the benefits for Chinese companies staying on U.S. markets are actually starting to decrease as capital markets in China become more mature, as they're able to raise more of their own money with secondary offerings on the Singapore markets. They're able to do this in Hong Kong. They're able to make secondary markets and other exchanges within China. But yes, I do think that NEO, that's one reason. Number two, at this point, based on company fundamentals, I think that XBond has a much better shot of being the company that's able to export their products overseas. that's able to, maybe not into the United States, but I think that their products are coming to China very soon. I know that they're already in Europe. They're selling relatively well there. And also, they're also targeting right now a much wider section down market, and that's kind of important. And their margins look really good, and they don't have this onerous relationship with JAC Motors. I think that NIO has climbed a little bit too far in bed with the government. And I know everyone sees this as a benefit, but in many cases, it's really not. And it can stifle innovation, right? So I'm going to reduce the risk in my portfolio. I bought a lot of NIO at sub $2 a share. We're talking thousands of shares. I'm pretty far up there now. Do I wish I had sold it in the high 60s? Certainly I do. But I'm also willing to part ways with the stock at a 10x return. So right now what I've done, and I announced this on my Discord earlier today, is I started selling call options on NIO. Normally I sell call options on all of my stocks with a delta of less than 0.2, which means I take a big hit on the amount of premium generating, but there's very little risk of a taxable event or having the stock called away. So now I will be selling options on NIO with a delta of greater than 0.3, which means there's about a 30% chance every time I sell an option that stock is going to get called away, which means eventually it will absolutely get called away, right? So that is my strategy. Is I'm trying to squeeze as much yield out of that stock right now as possible. I will reallocate the funds from NIO, and it's a significant amount. I'm going to take a giant tax hit on this, but it's all long-term gain at this point. But I'm taking a large tax hit on this. I'm going to reallocate those gains to a large part, roughly 50% of it or so. It's going to go into my regular ETF portfolio that's socked away for retirement. I won't think about it again. And the rest of it's going to, after I pay taxes, is going to get redistributed into individual stocks. And that is going to be probably what funds my Leaps buying spree. So that's going to, and it's a significant amount. And I'm going to turn around and buy some more established names at this time. So Michael Will says, don't mention the company with the bird in its logo. Okay, I'm not going to. We've talked about that enough. So yeah. So I don't know when the exact delisting date was. I think it's December of not this year, but next year. But it is, I'm starting to get concerned. And a lot of that has to do really with improvements in capital markets in China, where more and more people are funding they're not as even reliant as Western dollars in China, forming consortiums in order to get these companies public. They have a lot of domestic venture capital company, and it's not exactly venture capital in our these are big investment houses. And I just can't think of some of the names out there right now, but there's that the markets are capital markets, meaning what you need to take a company public, the money that you need to borrow from other people to take a company public, or the underwriting that you need in that process is getting a lot more mature in China. And so folks have less and less need. So I am a little bit concerned about delisting. Yeah. So you don't lose your holding if it delists, but it's going to lose value. You're either going to convert it into H shares, which are Hong Kong shares, or it's going to go over the counter. If it go, I think that, and there's going to be a huge difference, I think, in price between over the counter and Hong Kong shares. So, and who knows what markets are actually going to look like in 2 years. So I have a Ray Dalio type outlook on China. I think that Chinese stocks are priced very, very inefficiently. So I need to have a better understanding of what your Ray Dalio outlook is on China. I do think that prices our stocks are priced very inefficiently, but those inefficiencies exist because of the uncertainty of dealing with an authoritarian government that can make whatever rules they want to, and their investor class is really small at this point. It's not it's growing, but it's really small at this point. So yeah, I've heard Ray Dalio speak on China over and over and over again, where he sees this as the future. He also sees that low debt load is very attractive for China. But I do think that stocks in general are priced very inefficiently, but justifiably so. If you have been involved in Chinese stocks as long as I have, a number of them have gotten smacked down because the people in charge were not in political favor or said some things that were highly unpopular. Look what happened to Jack Ma recently. yeah, which is really unfortunate. And I heard the speech that he made that got him in trouble, and it didn't seem all that offensive or anything like that. I think it was really interesting. So, yeah. Are you looking at emerging markets in India, Pakistan, or particularly Vietnam? India would be the one country that I would take a look at this point. Probably Vietnam itself. The problem is me getting literature out of Vietnam that I can actually understand. Using Google Translate is really inefficient, and they don't have a robust any robust financial reporting. So getting into investments there has been very difficult. India, on the other hand, has pretty robust English language financial media, but there are structural issues with India that you don't necessarily have with Vietnam. And but I'm actually looking forward to more people being dragged into the middle class in India as they go forward. I think the India could be a huge growth story going forward. Yeah. So, what do you think about the David Hunter contrarian outlook on the stock market? He says it'll rally by the end of the year, S&P to 6,000 because the Fed will pivot. Actually, here's what I predict for the stock market. It's going to be far less exciting than people think it is, meaning that I don't think that further lows are going to get lower than about 3,600. And I don't think that further highs are going to get higher than about 5,000, meaning that 5,000 will probably be the best bet by the end of the year. There are just so many things happening. So even if we saw massive improvements in the supply chain, which helped to reduce inflation, remember, the Fed still has to deal with the massive supply of money that we have out there. It still has to deal with roll off on the balance sheet. It still has to do with a lot and normalizing interest rate environments. If you looked at the interest rate sheet that I pulled up earlier, interest rate environment is finally returning to something that is close to what is historically normal. These rates, especially out in the 5-year and 10-year range, are still kind of historically low. Taxable municipal bonds, though, are starting to return to kind of normal. And that's more what they want, which is long-term health in fixed income markets, where they're able to buy back some of that debt and then allow it to roll off the balance sheet. And they can do that at reduced prices because yields are higher. This is another part of the strategy that people aren't really talking about when it comes to reducing cash that's in the economy, and how higher interest rates can help if they can actually buy the debt quickly enough. And we see a corresponding reduction in government spending. And we have seen a reduction in government spending, even though political news will tell you that we haven't. We've seen a massive 20% reduction in the budget over the last year or so. And I don't necessarily, I don't know if I would love that to happen or not. I would like to see a return to about 4,800 by the end of 2023. And I think that's a pretty good bet, but I don't think I think there's an outside chance of the S&P heading back to 40 or heading up to 4,800 by the end of the year, but I think it's very slim. And I don't think the Fed's going to make a hard pivot. What they're probably going to do is gradually slow down their interest rates increase. The theory has been that they're front loading some of this to say they're serious on inflation and they're going to back off, but they're going to continue to raise about 25 basis points per quarter after they front load some raises. But I don't know. Anyway, this has been one of my longer live streams today. I did want to say thank you for attending. I didn't even get through some of the best recovery stocks on my list, but I am going to do that again tomorrow. Actually, I'll keep going over best recovery stocks tomorrow, and I'm glad to talk about your suggestions. And do you have an opinion on when inflation rates returns to the Fed target levels? So much of that doesn't depend on the Fed. So much of that depends on supply chain normalization. So I think that it's going to take at least a year. But thank you. And Al Lubis says, thanks for the stream as always. Great info. Thank you so much for attending, guys. I really appreciate when you guys comment. And please like and subscribe if you haven't subscribed. I look forward to seeing you tomorrow at 1 o'clock. I will not be on Thursday. I have family in town, and we're going to be partying all weekend and hitting the beach and all that. Thank you very much, and I'll see you later.